welcome to Business Morning here on Business Day TV. It's Wednesday, July 23rd, 2025. I am Destiny Momo.
And I'm Deborah Eze. Good morning and thank you for starting your day with us as we bring you clear data-driven insights as usual into the forces shaping Nigeria's business and economic landscape. From policy shifts to market trends, we go beyond the headlines to provide the expert analysis and context you need to make informed decisions.
And now let's move to the first conversation for today. The power sector in Nigeria is once again in the spotlight as recent data reveals that the federal government's debt to electricity generation companies, GenCos, has surged to a staggering 1.2 trillion naira in the first half of the year.
This mounting debt poses a serious threat to electricity supply stability, financial sustainability of GenCos, and investors' confidence in the already fragile energy market.
Now, what's fueling this debt? How are GenCos coping? And what does it mean for the average Nigeria and the future of the electricity sector?
Now, joining us to unpack all of this and answer all of these questions is Afolayan Ninimaya Oluwatobi. Is the Chief Technology Officer, Minad Global Technologies Limited. Good morning and thank you for joining us on Business Morning.
Good morning, Mr. Toby.
Yes, good morning.
All right.
Thanks,
So,
everyone.
yes, good morning to you too. Let's start with
Yeah.
the basics. What exactly makes up this 1.2 trillion naira debt? Are we talking unpaid invoices? Is this subsidies or a mix of factors?
Okay, based on that, to answer the question, I would like to just dig a bit into the basis. You understand? So I would like to start my point from the privatization era. That was era before 2013, and that was around 1970 when we used to have the PCN, the NEPA, Nigeria Electricity Power Authority. And back then, the generation and the distribution and transmission of electricity was actually owned by them, and it's being controlled by the body. I mean, NEPA. But after a while, around 1990s, there were measures, reform measures that actually put in place to ensure a proper running of the body. I mean, NEPA. But as at that, the result wasn't actually pursuing. So the privatization era, that was around 2013. The federal government actually worked on privatizing the process for the power sector, which actually led to onboarding the NEPA. And that year, that was 2013, we come about the GenCo that we're discussing about, the generating company, and we have the transmission and we have the distribution company. So that's 2013, the GenCo, 11 GenCo companies were sold, part of which we have the Kanji Hydro Power, we have the APAM, we have the Egbin Power Supply, Power Holding Companies, and so on and so forth. So I felt after the post privatization challenge arose from that end. She understand. Now, since the NEPA body has been onboarded, the challenge we have currently is the post privatization challenges. Now, let me dive into the question you asked directly so that I'll be able to respond to that. The money that we're talking about, the 1.2 trillion debt, actually is mainly from unpaid bills from power already generated and supplied to the national grid. So the money is actually the money we are actually referring to is the money that has not been paid, which the GenCo has actually supplied the energy to the national grid. You understand? The money as well includes subsidy arrears, the capacity charges, then market shortfalls. When we talk about market shortfalls, we talk about the electricity that has actually been supplied to the national grid and it's yet to be paid for. Okay, and then the 1.2 trillion debt as well includes the unpaid energy bill anyway. But just like a business owner, if you are running a business and the support, I mean the financial part of it is not actually properly kept, there will be big challenges. We actually dive into the political context. Federal government has been actually busy with few things, talking about subsidy, subsidy removal, new taxes, and big budgets. But I felt the energy sector, yes, the energy sector, the electricity energy sector is one of the sectors that actually needs attention in the era that we have. Because if this debt is not actually looked into properly and is not fixed in time, it might actually escalate into what the nation didn't actually presume would have happened.
Mr. Toby, you've said it all. This sector actually does need a very big attention, because we know that, and somehow electricity is trying to get better, but there's so much that they can do, because compared to other nations and as large as our population, we need to do extra more. Now the question is, how did we get here? What systemic issues or recent developments led to these massive accumulation of debt within just 6 months?
Okay. What actually led to this, from my own view, is like I will say, it's a cumulative issue. You understand? When I say cumulative issue, it's not something that is just coming up as at year 2025. You understand? It has actually been on ground since the post privatization area, since 2013. You understand? So, but the fact that the federal government didn't actually look into it vividly, or probably didn't actually make a mindful thought towards it, makes the situation escalate into trillions of naira.
Okay, so let's look at it from the GenCos position now. How are the generation companies currently coping with this financial strain? And do you think we are going to start seeing cutback in power production or maintenance?
Yeah, the way I think they are coping, one thing about business is you work based on budget. You understand? You can't work outside your finance. You understand? If you are producing a product, at least when producing a product, you actually need capitals. You understand, to venture into any business. So once you are producing a product and you have probably sponsors or people that are meant to be financing it, and if the finances are not actually like showing forth, you understand, they are not showing the support, the business will actually dance in a reverse way. You understand? So what I felt the result could be, if this debt is not settled, is we will face a lot electricity issues, which actually we have been facing. But we just wish and hope that this kind of conversation or discourse will make things get better, and the challenges that we are meant to face, if response are not given to the complaint, we'll be able to cut it off via this discourse.
All right, so what obligation does the federal government have under the current electricity market structure? And how well do you think it's fulfilling them?
I think the obligation federal government have is that federal government is expected to pay GenCo, that's the electrical generating companies, for energy not fully being paid for as discussed. You understand? So I thought federal government should actually look into it, on how the debt could actually be trashed out. Then under the power sector recovery plan, we have the power sector recovery plan, which is the PSRP. Yeah, federal government agreed to fund shortfalls, but it has actually failed in fulfilling the promise. Yeah. So then Electricity Act in 2023 gives more responsibility to the state government, but nevertheless, the federal government actually has to fulfill their key obligations at the national level. Yeah.
Okay. So do you think this debt crisis will lead to more grid collapses, load shedding, or even a power supply shutdown?
Yeah, actually, this debt crisis, just as is clear and it's not leading to anyone, if the debt crisis persists, yeah, I mean, if it remains and it's no action step is taken towards it, it will end up resulting to collapsing of a lot of generating firms and electric generation firms.
Okay. So does this situation highlight any gaps in the power sector recovery plan or even the Electricity Act of 2023? What do you think of this?
Yeah, what I felt is actually the government should actually look into this thing critically. You understand? They should address it head on head. In the sense that if a nation is facing a particular challenge, and when it comes to power sector is one of the delicate sectors in the development uh, stage of the country. You understand? Because power aids efficiency, like the way you work, productivity. Let me put that way, productivity. So if the power sector are not actually looked into properly, it will end in collapsing. That it will affect productivity, and more of the generating firms. I mean, electric generating firms will actually end up collapsing. So, but what I felt the government should do is to take steps into looking at solving the debt on grant, because once the debt on grant is being fixed, it will actually encourage investors, understand, private investors that are actually willing to dive into investing into power sector to actually go ahead with it. Yeah. Then federal government can actually solve the issue by injecting funds through the CBN or Ministry of Finance. One other thing that federal government can actually do is they should restructure the debt, like debt restructuring. Now, if the debt is actually probed into and they have a plan into how the debt will be fixed out, it will be a terms of agreement. Okay, maybe within this period of time, we will be making this amount of payment. You understand? And we will see the act of commitment. You understand? Act of commitment to trash out this debt.
Okay, so let's talk about immediate and long-term option, because the federal government paying off the debt, if it was an immediate option, we won't be here having this conversation. So what are the immediate and long-term option for settling or restructuring this debt? Do you think securitization or bond insurance is on the table?
Okay, the long term and the long term option that we have is just like I've said. Yeah, securitization will actually help, like them turning debt into tradable assets. Yeah, all these debts could actually be traded into an asset, in the sense that if you have a particular debt and you have people that are actually willing to come in as a body, you understand, to buy maybe bond, to get bond, you understand, to be able to sort out the debts. It will be a form of business transaction, like for investors, whereas they were having their interest, you understand, and as a result, at the end, we're able to sort out the bills. So federal government will actually issue out energy bonds.
Okay. All right then. Yeah. So how might this debt discourage private investment in power generation or renewables? Now, has investor sentiment already started shifting?
Okay. I think to that, I would like to go on a more practical level. Okay. Now, if the federal government could actually didn't or haven't sorted these debts, as an investor, an investor will be profit oriented, you understand, and will actually like to secure is fund and ensure that the person or the person is investing with or into, or a business investing into, is a kind of business that has structure, you understand, and can actually work with the fund and will be able to pay back with interest as at the time due. You understand? So foreign and local investor needs assurance of payments. Yes, they need assurance of payment. So if the federal government are not actually proving that, it will be hard for foreign investors to, or even on foreign investors, the national investors, to venture into it. Now, because there will be a fear of how do I say dignity or integrity in sense of you being committing and doing whatever you've agreed or concluded on doing. So actually, foreign investors and natural investors will look for alternative, maybe either hold the fund they have with them or find other sources, yes, within or outside the country to invest into, which will actually give them a secure source, yes, a secure source to invest in.
Okay, so what should Nigerians expect in the coming months if this issue isn't resolved urgently? And what are your recommendations, your advice for stabilizing the sector?
Oh, yeah, if the issue is not resolved, electricity will actually get worse. Yes, than we are facing at the moment. Yeah, because at the moment, it's not as if we have stable electricity, but at least it's not as worse as it would or it will happen if this issue of debt is not actually fixed or trashed out. Then more pressure will be on fuel, yes, and on other alternative sources. Yes, of recent, people actually diving into renewable energy, you understand? And if the debt is not fixed, there will be pressure as for people that are using generator, diesel, yes, for alternative source of power supply for their homes, business, firms, and all. So I think then there will be hike in tariff without improvement. You understand? Now there will be hike, and when there is hike in tariff without improvement, just like we are heading for a big issue in the sense of you paying a bill for the energy which you are not able to harness, which you are not able to use. It's actually not pleasing, and it actually end up in something else.
Yeah. All right, we've been talking to Mr. Afolayan Nehemiah Oluwatobi, the Chief Technology Officer, Minat Global Technologies Limited. Thank you for all the unveiling you've done on the power sector issue this morning.
Thank you so much.
Thank you. You're welcome.
All right, we'll go on a quick break now. When we come back, we're going to be having the second part of our conversation on Business Morning. Do stay with us. Welcome back to Business Morning. Now let's move on to our second conversation for today. At its latest Monetary Policy Committee meeting, the Central Bank of Nigeria held the monetary policy rate steady at 27.5%, despite a noticeable slowdown in headline inflation, which is to 22.22% in June.
And the move signals a cautious approach by the Apex Bank as it attempts to maintain recent exchange rate gains, guard against a rebound in inflation, and also stabilize the macroeconomic environment. But with the GDP growth lagging behind expectations and businesses warning that high borrowing costs are stifling productivity, questions are mounting about whether this monetary stance is sustainable.
Yeah, and joining us to unpack the decision and what it means for Nigeria's economic outlook is Ambrose Omodion. He's a financial analyst.
You're welcome, Mr. Andrews.
Yeah, thanks for having me.
All right, so let's start with the big picture. We always like to start with the big picture here on Business Day. Now, the CBN has held the MPR at 27.5% despite declining inflation. So what's your interpretation of that decision that was made yesterday?
Actually, those that followed me on my different fora, I've said that we're not expecting a cut in this MPC meeting because, one, we have seen that in the global economy, we have seen that most of the mature central banks left their rate unchanged for this season, especially considering the tariff uncertainties and the global also the political tension here and there. And coming back to our nation, look at our very considered decline in inflation after the rebase. We'll notice that the last result that was released, which was for the month of June, there was yes a decline in terms of year to year, but if you look at a month to month inflation, we saw an uptick in food inflation and core inflation. That alone is a sign that our inflation is also likely to come back in a moment from now. And for CPN that are left rate unchanged for for the month of February and May, looking at that recent report, I'm not expecting to cost rate immediately. Yes, we have two other meetings for this year. The coming on the June, September, and the November for the last of the year. If looking at what has happened, you mentioned big picture. We look at our exchange rate. Yes, we have successfully for let's say for the last 3 to 4 months stable, which is good news for Nigeria. But if at this point you start cutting rates, I'll tell you that there will be increased demand for that same FS for expand. But that is not really the issue at this point. And because the global economy is still shaking and insecurity in Nigeria is still at the peak because farmers are not having access to their farm land to produce. On that note, cost of transportation, yes, despite the rebase, factoring some new sector is coming up, we know that here cost of transportation is still relatively high. Despite we're seeing fuel price oscillating between 860 to 890. But still, movement has not changed in terms of cost. For that, it's also reflecting. And also, don't forget that it's only recently that most companies are looking at alternative for energy. Energy cost is still high. I mean, this factor that will support inflation to rebound and also start looking up are there, despite the debate. For me, that's why they're taking their time to watch between now and September, the next MPC meeting. If we see, yes, that there is little stability, they cannot be thinking of cutting to usher in the last quarter of the year in that dimension. But I believe that what we experienced so far in terms of figure, looking at the GDP also tells you that we are not ripe to cut rate now. Because even the rebase of the GDP, we are seeing that it does not really show the position of the economy. I was thinking that in the rebase GDP, we're going to see new sector that will factor in, not just changing figures alone. That's why most times when GDP figure come, just for us to use it for set of analysis or guide, but I see that they are not giving us the real figure. I always say it in India, they're not giving us the real figure from that number of statistics. If really you want to factor in new economy, new sectors that are just bringing up to Russia, yes, that there was a transformation in terms of structure. Whereas we have seen the thing coming on board in the oil sector, making that sector so robust, which also we can see increased production. But apart from that, we're also seeing that new tech is coming in. We're seeing new companies coming up in tech business that also expand in that space, despite the big names that are there. All this also reflect there. And also, even the recent bill that was passed of tax that are going to take effect from next year, I don't see all reflecting, because if you say you rebase your GDP, fine, we are back to like around fourth position in Africa, saying that yes, after we have led before now. And also, if you look at all this, tell me that the rebase GDP is just an exercise that not giving a real picture of the economy. But CBN not cutting rate at this point for me I'm not surprised because that's what I forecasted and that's what happened. But I believe that going to the future, if before September there's movement, that's what we're thinking of what. Because gradually now, most of the mature economy, their trade agreement is coming. We saw the recent one that came from the US and Japan. That is a good one. Why US and China also finally, will soon finalize their position. These are the things going to take the cost and all. But I believe that CPN has another opportunity between now and September to monitor all this, because if that's also continued decline in fixed income market, it's also a pointer that we might likely see it. But for me, that inflation figure that came in the month of June, when I said I don't expect a rate cut at this meeting. Even when many analysts also were saying a rate cut, I didn't expect it, and that is what happened. But between now and September, after seeing some improvement in some other macroeconomic data, when I likely see to because anywhere in the world, CBN look at what data to take it. They don't take just on feeling. Data is what anywhere in the world you look at your data in the economy to consider whether you cut or you give your rate.
All right, Mr. Ambrose, you sound so sure, about being from now to September for that to happen. But meanwhile, inflation has actually slowed for 2 consecutive months. Why might the CBN still be reluctant to ease these policies?
I mentioned it in my allusion, my direction of saying that because there are 2 major things that happened in July inflation. We saw that the core inflation and food inflation had an uptick, even though having year-on-year decline. For that, they don't need to cut rate. That is the only thing.
Okay. All right. So, how much of this decision was driven by desire to maintain the recent naira stability in the FX markets? Because you mentioned that this is not what the CBN needs to be doing. So, do you think this was actually influenced by the desire to maintain, the naira stability in the FX market?
Yeah, it's part of it. Why I say so is that if you quickly rush into cutting rate, going to put pressure more on what? Because demand, I tell you anywhere in the world, when there's cheaper fund, they will demand for expansion. If like your company now, for example, if you take it down, you need to employ more people, you need to buy more equipment, you need to expand business to really reflect. On that, there will be demand for what? For more effort. I want to import. But for me, as they are looking that we're already increasing our production in terms of oil. Look at Nigeria. This is the second time we're having to meet OPEC, OPEC quota in terms of oil production. Yeah. So that is sustained. We're going to see more influence in terms of FS for CBN to use to sustain what they are doing. Because I tell you, they need to also play their role and they need more money. For me, if we sustain that production, then before end of September, like I mentioned earlier, what I said was that this opportunity to see how the global economy also is going, now give more insight whether to start cutting our rate. And it's good for us, we can drive our economy to achieve the 4% forecast growth by the government and that of World Bank at 3.6. Well, if you don't have kind of cheaper fund, you might take, because economic activity is what drive GDP, not the figure you have in your bank account. It is the economic activity that drive GDP. If we cut trade, that will help us to achieve that, but not immediately, but I do before the end of the year. That will likely to happen so that we can achieve. But if you look at the GDP that will rebase, and even the previous one in the last quarter of 2024, we are still below that. Even with the rebase of our GDP to about 300 something billion, before we have touched almost 500 billion in terms of GDP, but still now we're in fourth position in Africa, which is also for me, okay. But to sustain it is what matters, not just cutting, because what really kind of reduced our first rebase in 2014, where we're about 500 leading in Africa, is because of exchange the issue. We saw a lot of some assault in our exchange policy that affected us. Now they were rebased. What matters is that how can they sustain it? And if FS is sustained, that will show this rebase will be sustained. But if FS also tumble again, we're going to go further low. That's why I say they need to look at stability in FS before we cannot talk of reducing costing rate to drive the, because we need to cut rate to also buy cheaper fund that will drive the economic activities.
You're so right when you say that it's the economic activities that actually drive the GDP. Now, is there a risk that the effects of tight monetary policies are lagging and that the CBN might be over-tightening at this point?
For me, if the inflation rate is ugly head, they might likely tight further or the board. My own is that if inflation starts going down, because anywhere in the world, the rate, the monetary policy is thought to checkmate inflation. That was price stability is their major role. If that's seeing inflation, it starts going down. Like I said, if the uptick we saw in the food and core inflation for the month of June started coming down, when we start seeing production, harvest period start coming. Despite that farmers are not farm. If there's some states that are still able to go to the farm, we're not seeing harvest period, we're not seeing inflation slowing down, then they cannot think of what cutting rate in their next MPC meeting.
Okay, so the CBN's business expectation survey says that firms very high with interest rates as a bigger challenge than even security or power issue. Now, should the CBN be more responsive to that real sector?
Yeah, come again with your question. I didn't get you.
All right, so the CBN business expectation survey says firms view high interest rates as a bigger challenge than even insecurity or power issues. So do you think the CBN should be more responsive to the real sector?
Yeah, actually, they already know that, yes, cost of fund is very, very important, and that's why they are saying that. Also, if you look at also that same report we had already did, they said most companies are really kind of stomaching their high cost. That if they pass that high cost to the consumer, it's going to also increase up rate. And that's why if there is rate cut, that is where they can beat out. Because if I read report, I've read through it, they said that most of the corporate body are kind of absorbing the high cost and they're not passing it to consumer. And now they are also saying that yes, interest rate is their major issue. If they increase interest rate, then that's going to be a kind of a blow to corporate body. But one thing that I will give to Nigeria corporate body today or business is that despite the headwinds in 2014, 2024, sorry, 2024, we saw that most of the company posted, kind of improved numbers that also impacted their numbers and their dividend and stuff. But now that we're seeing relatively stability in FS, and also we're seeing a mixed macroeconomic data in 2025, and like I said, if they can sustain this exchange rate at this point, company can easily plan and forecast. We believe that before like that September, that they will support. One thing that they know that yes, cost of fund is a major factor that drives expansion. Even though we're saying the inflation, security, and all those stuff, but if your cost of fund is low, more activities, and that will oil the economic activity.
Oh wow! So are there other monetary tools beyond rate hikes that the CBN could deploy to manage inflation and also stimulate growth at the same time?
So at this point, what matters is that the CBN have no role to when it comes to fiscal authority. In terms of security, that is pure fiscal angle. But for CBN, they have a major role. One, to price stability and also provide good environment for business to strive. And that's why we do their meeting every month anywhere, so that some countries every month, some 2 months, so that you know where the economy is going. You now use your tools to pick the economy, to put the economy in the right direction. Now, last year, 2024, we saw good all through. Hike all through. But this year, this is the time we're seeing a hope. For me, it's a good one. It's a signal that they are gradually coming toward the path of cutting rate. That's why it's not immediately, but I believe between now and that September, if what we saw, like inflation start also cooling down, we're likely to see rate go. If not that this too ugly that we saw in June, I would have said expected. But because of inflation pick up in the food and the core inflation, I don't expect. But if because of harvest, as I mentioned earlier, harvest is coming, we're not starting inflation coming down. That cannot usher them to start cutting rates. Yeah. And the key rate you're going to cut might start with a 25 basis points, and then cannot go to 50 depending. Also, don't forget that towards the end of the year, we see a lot of business activities. If they cut rate at that time, that will help the economy to achieve a lot in that last quarter of 2025.
Okay. Let's look at the bond and the equity markets. Do you think this cautious stance will affect investor confidence?
Yeah, for me, we have seen that the fund that's supporting the market as we speak now, most of them actually fund from foreign investors because of our earlier devaluation. Bringing any money from foreign currency will impact more on the market, and that is what's also. And also our institutional investors here, the PFAs, are also having participating in the market. But they understand the movement of funds because anywhere in the world, interest rate is what we call a trigger circular flow of funds from bond market or to fixed market. But now that we are seeing the rate code, the next monetary policy or the next treasury bill option will give a sign. If we see an uptick in that rate, it will not tell yet. If not, I was still seeing a decline, more funds will enter equity space. And also the good news that for equity space, we have seen impressive numbers that have started hitting the market right from almost 6 years ago, and that have been sustained. If that number, as our eyes are on Q2 to start, as few, we have seen few of them, that what that came from, Lafarge Africa, beating market expectation. If that trend continues in that industry, and other sectors will start bringing better, I would say that the equity market will be able because it's signal at the end of the year a better dividend will come. And for those that in fixed income market don't want to take risk, they know that yes, if rates are continue to come down in fixed income space, they come back to equity space because companies on the estate are posting better number that will support a higher payout at the end of the day.
So now, what key indicators should we watch in the coming months to know whether a rate cut could be on the horizon?
Okay, actually, we have seen the rebase, GDP, and I tell any investor that you don't need to wait for government GDP. Personally, I don't wait for the figure. It comes, I don't look at it and analyze it. If you read the Nigeria economy expanded in Q2, now that we're expecting the numbers, and they are coming, will tell us that yes, we're seeing an improvement. Already they're giving us now GDP for first quarter, the rebase about 3.13. Then if you also see Q2 number, will tell you a performance of our GDP, how it will look like for Q2. That will help investors to kind of prepare for the next quarter, which also be for 2020 fourth quarter of the year. But I believe that what it does to look at corporate earnings, and also look eyes be on this inflation data to guide you. Because that's the only way I know that if there's high inflation, there are some sectors that will pass this high inflation to consumer and still make post positive earnings and the pay good dividend. That's why even anywhere there's inflation, there's equal investors should also look at the market to know where to position, because there are some sectors that their service or their product are essential, that even when there's inflation, because that sector or that company can easily pass it to their consumer and they still make money and pay high dividend and also support their price, than take it to know where there is low risk and your return is low, so you can take calculated risk and move to equity space. That's why after this meeting yesterday, today you see that many companies will doing try to digest or kind of analyze the outcome of this meeting and also look at the strength of GDP with the outcome of MPC, where next, and put that those sectors are emerging because of government policy. We have seen that the consumer goods market sector, which is the engine room of any economy that wants to grow, and that's why CBN also is looking at if they cut rate in the last quarter of the year, it will further boost the market sector, and which is it's only in Nigeria you see that the service sector that is contributing more to the GDP than the production sector. It is because cost of production is high, cost of labor. But if we start cutting rate, that will help for that sector also to contribute to our GDP and also drive the economy. Because where you see that this sector is driving the economy, for me, it's a good place. But when service sector is also driving the economy, for me, it's not too good. But it's also can't cancel it. But when you see production, that's why today, look at China, look at Japan, because their production sector is what driving their economy. We want to come to that stage.
Oh, wow. So we've been talking to Mr. Ambrose Omojan, a financial analyst. Thank you for joining us, sir.
Thanks for having me.
All right. It's been insightful topics this morning, starting from the power sector and now to the CBN GDP rebase. I'm just going to give my thoughts on everything that was discussed here. Okay. I'm going to start with the power sector, and for me, I would say for the power sector, 1.2 trillion naira, it's not accounting. Because when we hear the numbers, it sounds like accounting. For me, it's a crisis. Okay. And to think that they just want to the arrears is just for the first half, with total debts now at 5.2 trillion naira. That means Nigeria's power grid is teetering on collapse, and we are facing blackouts. And tomorrow, not today, you might wake up and you see that you don't have light anymore. In as much as you are paying so much for it, you find out that there is blackout. And the fact that the government is pretending that this tariff cut is dressed as a reform. They come in with the band A to, and I found out now that there are 5 bands, band A to band E. They dressing it as a reform just speaks more of the risks and the crisis that we are at here in the power sector.
People actually are happy that there's the little reform in the power sector is. Some people will say, in some areas they enjoy the service, but they also still complain that the cost is killing.
Should we do a survey on people that actually really enjoy power supply?
How is it in your area?
It's very well in my area because it's more like a private owned or private paid. Oh, wow. Let me just pause at that. But if we do a survey on the number of people actually getting power supply, you find out that it's actually little to none.
True.
But moving on to the second conversation that we had, which was on the CBN GDP rebase. For me, I think in all of this, until oil is back to target and the private credit opens up, the real growth is still elusive. And I would agree with Ambrose. I think it's not really it's not smart. The CBN is actually playing safe, if I do say so myself. It's not really a smart move, because without reform and a healthy fiscal sector, the rates will still hold, it will still become an economic shackle and shamble. So I think they're just trying to play safe, which is actually not a good one. When it comes to numbers, playing safe is not always the way to go.
But then how do you think they were still going to be able to, solidify the whole debt issue? Do you think it's something that they can actually fix with the timing he gave?
That's what I'm saying, that until oil, we sort out oil, until oil is back on target and private credit opens up, we would not experience growth.
Oh, wow.
No matter what they do to the numbers, we are not going to experience any form of growth. That is just my take on this.
Oh wow, and that's so much we can take on Business Morning today. Up next is Big Story. My name is Destiny Mama.
And my name is Deborah Eze. Keep watching Business Day Television.
Good morning.